Okay, good morning, everybody. Welcome to QuantBox Live, where we get our global macro on. We got a brand new week and CPI tomorrow. The big event of the week is tomorrow, CPI Tuesday. Always seems to me like it should be on Wednesday. But, anyways, let's get on with it. Well, hey, Wayne, what is QuantBox? Well, first of all, it's a way to automate all your macroeconomic research at your trading firm. Whether you manage $1 billion or you're trading in your kitchen, you can trade the same. You can have a quantitative analyst doing macroeconomic research for you. Well, if you're a hedge fund, you probably spend $300,000 a year plus $1,000 a month on a Bloomberg terminal. Guess what? QuantBox is less than $300,000 a year. It's not even 200,000, not even 100,000. Yeah. So, anyways, look, it's automation using artificial intelligence. Yeah. Now, why is that important? Well, it gives you confidence to let your winners run. Hey, by the way, my name is Wayne McDonald. I'm what you call an economist. I'm also a trader, investor, a lover, but not a hater. I love macroeconomics. It's the basis to all my trading and investing because I want to know why the markets are moving. Not just that they're moving, but why. And so when you gather intelligence, you can formulate a strategy. So today, for example, we'll look at the new Commitment of Traders report. And we'll see institutional positioning, where all the hedge funds have put their money. And more importantly, where the money is flowing to or away from. It's not just a static thing like this many contracts long. Has that changed week over week? And so we want to see the change in capital flows to make our investment decisions. Okay. So anyway, swing on by quantbox.co. Take a trial. It's not very much. I got some very big news I'm going to try to release this week. Very, very big news. And trust me, if you're already a subscriber, you're going to smile. Cool. And then I got a big thing that we can do if you want to do for the future of QuantBox. If you want another giant leap forward, we can do it together. All right. So, anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never miss risk money you cannot afford to lose. Got to log in. Makes sense. Boo. Look at all the pretty colors. All right, let me go big, if you don't mind. All right, pretty quiet, over the European session and Asian sessions. We'll take a look at where we led off or ended the last week. Look, yields are a little bit higher. The market hasn't opened yet, but this was as low as 4.53. Now it's 4.63. Not really terribly meaningful. Still a lot less than 5, but really not a big mover over the last few days. So I'm okay. That's fine. That's fine. Oil has been at this price now, I think, for about 3 days, not including the weekend, of course. Okay, 3 trading sessions. Down at a bottom, a predicted bottom, and then it double bottomed, and then it made a higher high and higher low, which it's all supposed to do. So really, oil is supposed to go up today. Technically. Anyways, if you believe in technical analysis. Gold, meh. Not yet. Okay, gold is maybe long-term bullish, but ain't doing nothing yet. S&P 500 had a good Friday. Yeah, had a nice little move there. And the big thing again tomorrow is CPI, and CPI is expected to be low, or I would expect CPI to be low. And if it comes in low, and in particular lower than expected, people are going to say the Fed's done raising. Now, the Fed always can raise in the future if inflation is rising, but if it's falling and it falls fairly significantly tomorrow, well, then people are like, okay, we're at the top. We're at peak rates. We're at the terminal rate. And then now it's the big question is just for how long? And that's the, um, high for longer. So, anyways, that'll be the big news today. And if, so if we get a low CPI, the stock market probably will rally again. Another big week. Now, in my humble opinion, why would CPI be low? Uh, Oil prices are down. Oh, that's right, Denise. That's right. No, no CFTC data. That's right. I forgot about that. Thank you for reminding me. All right. So, anyways, with oil and gasoline prices down, it's an input cost to a lot of things. So anyway, so that might actually, great. We'll have a great November. I'm okay with that. I'm okay. I've been very actively not hedging. I'm very often, very actively almost hedged. So, anyways, we're still around 107 euro dollar. Okay. At Bitcoin, excuse me. I had a Bitcoin last week and I got rid of it. I think it was about 37,100. And yeah, so I'm happy with this because I'm not in it anymore. So, good call. It didn't feel like the right call at the time. Okay, let's take a look. Has anything over here changed? Yeah, yeah, yep. Friday was a good day. Now, one big thing that happened on Friday is I think almost another downgrade. I don't think was the U.S. actually downgraded by Moody's or warned. I think it might be a warning, but anyways, it kind of does the same. Um, the American government is considered dysfunctional, and that's a major risk. And that's the interesting thing about how the loss of a reserve currency status starts, right? Super high debt, and then the people managing the debt and the spending are incompetent. You're like, why would you lend money to your crazy deadbeat Uncle Sam? So, anyways, sorry, America, but that's how the rest of the world is starting to see it. So, anyways, so the third of ratings agency either has or is considering lowering the AAA rating. So bad news bears. But nonetheless, hey, we're trading interest rates. So let's see. Volatility way down on the VIX, huh? That's really good. S&P 500 up again. That's really good. Okay. Gold up a little bit, almost 1% for the month. Yeah, okay, that's not so great. Yields are flat. Okay, neither here nor there. Dollar is a little bit weak. Oh, that's good. Yen futures are weak. Oh, that's good. And we're back to risk on. If you recall, I think it was on Thursday, these were all mix, mix, mix. So it's leaning more risk on again. Isn't this helpful? It's a pretty page, isn't it? Because it's looking at such a diverse basket of of assets. So you could just look at these gauges and you don't have to be flipping through yen charts and dollar charts and yield charts and gold and S&P 500 and VIX. You're not watching them minute by minute and trying to balance them all out and do all this manually or mentally, let's say mentally. It's just boom. And of course, it's hard to do all that in 3 dimensions, right? Short, medium, and long term. So this is a really nice page. Okay. Now this is looking at completely different data. And it's just looking at, well, candlestick data, what's occurred over the last few hours. Okay. And all right, well, looks like Friday was a nice day, risk on. Anything else going on? Nasdaq not quite there. With that, I need to buy dips, I think. I think I'll be buying dips in Nasdaq. To me, it's tricky because it's already valued quite high. And I don't like buying high, so I have to buy dips, but there might be little dips. We'll see. Um, Either that or I got to hold cash for many months, and I don't want to miss any sort of like this regrouping. Um, everything feels right as rain, by the way. Everything so far over the last few weeks seems right to me. The only thing that's happened that has been sort of unpredictable was the Hamas attack on Israel. And that threw our stock markets off for only 2 weeks, but you don't know at the time that it's only 2 weeks, right? And so everything, all these things that seem to be going up should be going up. And okay, great. So there's that little blip, but now it makes it difficult to I don't know, get back on the moving train. Yeah, so this didn't update. Let me just confirm that. Yeah, it hasn't updated. You guys enjoying the new COT data though? The updated table? It's nice, isn't it? I appreciate it. In particular, this. Okay. So you can sort it now by the flow of capital, money going into platinum, money coming out of the Japanese stock market and US oil. It's nice to be able to see it. These are actual contracts. So now, right, we can see the flow of capital because you might say, oh my God, look how bullish oil is. And then we go over here and say, yeah, well, money is flowing out of it right now. It's very bullish. It's 80% long, but money is coming out. Less long and more short. That's significant, right? Good to know. Good to know. Good to know. I guess we can look at some seasonality here. No, that's not. What else is going on? Yeah, Bitcoin. Thing is, it might have had a good week, but it's been sitting there for quite some time. Now we're at 36.8. So I'm very lucky to have gotten out on Friday where it was. I'm mad at them though, at Coinbase. They're like, it's fast, but it's still pretty expensive to receive in Bitcoin and convert it to cash. And then they're like, well, if you upgrade your account and pay some money on a monthly fee, we'll reduce we'll get rid of the Coinbase fee. Okay, great. Good. So I upgraded that account. Right. And then what? So yesterday or on Friday, I'm sitting there, I'm like, and it's showing me the Coinbase price. And it's 37,050 or something. And I'm looking at the price on Trader's Way and it's 37,050. Everything's great. Watching it for hours, watching it for hours. And then I go to take profit and then there was like a $300 spread. And I'm like, but I thought I was paying money up front to reduce like a Coinbase fee. And all they did was then jack up the spread. And I'm like, dude, that's not right. Something seems wrong there. Someone's made a very poor decision. So, anyways, there's some manager at Coinbase that says, hey, everybody, let's screw our clients. It's a good idea. Thank you, Coinbase. Thank you, Coinbase. Yeah. All right. What else? Oil way down. Obviously, the thing is is it going to stable where we are? Stabilize. Same thing. Like, I'm very interested on the very, very long term. Like gold and oil, I'll just look at. Like oil and gold are down quite a bit. I'm wondering on the medium and long term. Like, I don't know. Let's say over the next year I wonder if these are about to print bottoms. Like if we're going to say, where is oil going to be in a year? Where is gold going to be in a year? I think, let's say in the at least in the next, let's say 90 days, will they hit some sort of bottom? So in a year or two, we look back and say, wow, I bought gold at 1900 or 1800 or like oil right now is at 77 and some change. Is that the new low? The last one is at 65. Are we going to go all the way back to 65? Are we going to go all the way back to zero? Okay. What if the United States next year is in a soft landing, higher interest rates, but no recession kind of thing? Okay, GDP, inflation slowly stabilizing, maybe not at 2%. But what if it stabilizes around 2.8? Can you live with that? All that kind of stuff. And GDP settles it down around 1.8. And we just kind of continue on, and the rest of the world, like China gets its act together, maybe, like think of all the positive things instead of all the risks. Could that shape up? Well, if so, what does that mean for gold and oil? And in particular energy. Like if you look at um, projections for next year for demand, what if they're low? You know? So, anyways, yeah, that's our job. We got to watch that. So, these are the things I'm actually looking at this week. Oh, I forgot to tell the team. Oops. Boo, 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 boo. So money has come out of the Japanese stock market, but it's still very bullish. That also part of this implies a weak yen. So when you look at something like Kiwi yen or Euro yen and they're neutral, well, something might turn on some of these to make them go from neutral to bullish. Okay. So that's what you would look at. So what's holding these things back? Euro yen is definitely not going up GDP wise. All right. But often the market, remember, this is just the economy. The market is what, the next step. What do traders do? What do investors do? So, you'll see like investors are doing the trends. Let me just highlight it. Oh, cool. Oh, good night. Okay. And the market, is technically long and it's looking at COT flows and retail sales to be okay. Seasonality is okay. And some of these other things are just maybe they're too long term. People know GDP is bad in Europe, but maybe it can't get any worse, kind of thing. Oh, it can get worse, by the way. Yeah. Inflation is bad, in some of these places. Or maybe you lean on you prefer Kiwi, or you prefer Swissy. Okay, no interest rate differential, but inflation's okay in Switzerland. Okay, just money's not going there right now because a weak Swissy is actually risk on. So, anyways, I think a big part of your job is watching all the neutrals. Don't just stare at the things that are bullish or very bullish or bearish or very bearish, because they've already happened. I mean, there might be a sustained trend going on, but I think the value creation is analyzing the neutrality and figuring out what direction are they going. Are they becoming more bearish, or are they becoming more bullish, and being sort of early in that new move versus doing what worked 3 weeks ago. Now, this economic data doesn't change very often, right? The one thing that might change, or does change the quickest, is technical analysis. So that might be a column. So for example, very bullish on the Japanese stock market, but it's got a weak technical trend. Ooh. Okay, you see how that's important? How about this one? What's going on here? Okay, a weak bullish technical trend. Is that turning bearish, or is it going to turn bullish? What's next? And so you might dive into that. So that was Kiwi yen, right? So we could go into a price forecaster. Okay, and of course we generate all of this from candlestick data. So we go to Kiwi yen. And so where are we now? Okay, we're at about 89.3. And best case scenario for the week, we get basically to 91. 1, 2, 3, 4, 5, 6 days from now. So the seventh day. So that's looking quite a bit forward. Okay. And how do we get that? That's one standard deviation above the mean, best case scenario. So it has to calculate the standard deviation, which means it has to calculate variance, and it has to also calculate this, not just the mean, but the slope of the mean. What's the worst case scenario? Well, it's still bullish. Okay. And so instead of being up one standard deviation, it would be down one standard deviation. So there's a drop, somebody buys the dip. And so we're at 89.30, a down period, and then back up, back to 90, which is about the average price. Base case, okay, we just have a slow and steady increase over the next few days. And remember, all it's doing is calculating the slope of the mean and then doing a linear projection. You could do that out 1 million days if you wanted. It's easy. It's like shooting a laser. That's all it is, right? I said that like Dr. Evil, didn't I? Gee whiz. Who grew up in the 90s, huh? A laser, a freaking laser. Oh my God. Yeah, must be Monday. Okay, so we can dive a little bit more into that economically. Okay, so here's the a cleaner version of that um, best case, base case. It's all neutral, so there's no targets, and you see the gray. Let me highlight the gray in gray. Okay, I'm gonna highlight the gray and gray. All right, you see this? Okay, this is what's happening. Okay, it's up, but relative to what's normal, and I'll do sort of what's normal in pink. Okay, there's the dip. See how it was everything is generally okay. And then boom. Okay. We should be way up, but we're not. We're not. Okay. We're not. We're flat when we should be, we should be here and we're only down here. Okay. So maybe we're just topping out early, no big rally, but I thought we had yield curve control. Yeah. A lot of it was here. Just not a lot of love for Kiwi right now. That's all. Pays well though. Pays well. That's your income. Okay. Especially when you become sort of a bigger trader or investor, aka you have more money. You negotiate with your brokers and you say, look, I want the institutional carry. I want as much of that 5.60 as possible because with smaller brokers and retail accounts and all that kind of stuff, very often you don't get you only get some of this, none of this, or you pay negative spreads on everything. It's because if you only have 5 grand in an account, how's the broker supposed to make money? Right, like they really need to scramble to find a way to pay all the bills because there's just not a lot of money in mini lots, right? And so, but if you're an institutional investor, right, and you have a prime broker, they'll give you, let's say all of it if you have millions. Okay. But the cool thing is with a little bit of leverage employed, with 10 to 1 leverage, you're think of like buying the Kiwi yen, think of it as buying a bond. And with 10 to 1 leverage, you're earning 56% a year in income. For every $1 million, you collect 560,000. That's pretty good. Yeah. Well, with 1 million to 1, right? You could turn 1 million into 100 billion. Yeah. Yeah. Well, be careful. But anyways, so I don't know if a big prime broker would give you that that amount of leverage, but nonetheless, nice returns. Nice returns. That's a good carry. The way to think of it is if you earned all of that and you had 100 to 1 leverage, okay, you're going to do really well. Neato. Neato. Very short. Retail is very short, and institutions are just not buying Kiwi. I think that narrative will change if China changes, but I can tell you where part of that institutional narrative comes from. And that's part of, if we go here, go back to central banks and you pull up New Zealand. Loading, loading, loading. It's the biggest dog with fleas. Or it's a small dog with big fleas, right? These are elephant fleas. Yeah. Right. Elephant fleas on a Chihuahua's back. Yeah. So, anyways, what this is showing that all that love that we were just talking about, that 5.6 carry, won't last very long. And so it changes the relative direction. Okay. So next year, if we were going to sell something, Kiwi might fall the fastest, as it shows over here. So QuantBox helps you organize all of this. Isn't that nice? Okay. It's nice, right? That you can have that. Yeah. And then how how do I calculate this? Is this my guess? No, no. That's the Reserve Bank of New Zealand's guess. The people that actually make those decisions. Cool. It's nice to have that. All right. So, wrapping up, for the biggest thing is tomorrow, and that's going to be inflation. And I think inflation will not be a high. And my logic to that is gasoline prices are low and oil prices are low relative to the last several periods. If you recall, we looked at European GDP recently and it dropped very significantly. Or I should say inflation. I wonder if I have it here. And it dropped very significantly. And then when you break it down, the components of European inflation, the only thing that fell was energy. So I'm taking the same logic there and saying, well, the decline, there you go. The decline in inflation in Europe has to do with the decrease in oil and gas prices and has nothing to do with their economic policies. But if I can have that opinion here, then I should have that opinion in the United States too, where if, assuming Fed policy is at least neutral to the economy, then a decrease in inflation, a significant decrease in inflation, is reasonably predictable. So we'll find out. I'll be watching the stock market today and oil today. Those are my biggies. So I will see you later. I will see you tomorrow. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful trading day and be safe.